For another edition, guys, of Trader's Edge. As Sean just mentioned, we're going to jump into the wide and vast world of gateways. Obviously, a very in-depth topic that has lots of subjects and lots of things to cover. So let's jump right into it. ATSs, gateways, ATSs, we'll refer to them as alternative trading systems, or ATSs, going forward, if you're wondering. So the first thing we have to kind of discuss is direct market access. So a lot of the online kind of retail discount brokers don't even offer direct market access. So when you send, an order to your broker with their fancy, buy or sell keys that are on their very flashy, proprietary system, their trading systems, it's actually your broker that's filling your order on the other end, and then they go ahead and trade out of or into a position on their end, but they're the ones that are filling your order. So direct market access not only gives you a look at the depth of market, or the level 2, but it also allows you to send your orders directly to the market. So the first thing we have to do is touch on kind of the fee structure. Obviously, in North America, here both in the US and in Canada, markets run on a make or take kind of fee structure where you're paid a credit or a rebate for providing liquidity to the market, and vice versa. If you remove or are aggressive, you pay a fee. In South America, markets run on a basis point fee structure. We'll touch on Bovespa coming up in a little bit, but let's jump right into the first point here. Starting in the US, Neil's over at the screen. He's going to be the knowledgeable one here. Starting in the US, let's touch on a few ATSs and some of the common gateways, Neil.
Thanks a lot, Brennan. So I guess I'll be the knowledgeable one today. I do a little bit of rebate trading, so I have to use the different gateways very often. It makes you very familiar with the different structure. The most important thing to consider is that price is going to dictate the #1 differentiation point between these different ATSs. And when I pull up either my NASDAQ or New York keyboard setup, I have over 32 of these set up. We're not going to talk about every single one of them, but I have a stock here, and I just picked this file because it's going to show you a nice depth of book displaying all of the different gateways that we're going to talk about. Now, Brennan talked about the maker-taker model. So the first thing you want to note is who's going to be paying you a rebate. So some of the prominent ones are, whether it's on the Amex, whether it's New York, whether it's NASDAQ. In the US, you're going to be talking about EdgeX, DirectX there. BATS is another one going to pay you, and ARCA. And down here, NYSE is also paying you, and NSB. So to differentiate between some of these, the top 3 in this book, where people are adding the most liquidity, as you may have guessed it, they're going to pay the biggest rebate. They're all paying about $2 per 1,000 shares. So if you post about 10,000 shares here, you can get paid $20 just for waiting for your fill. If you want to look down here at NYSE, they're going to be paying a little over $10 per 1,000 shares, and NASDAQ as well, paying about that rate. Now, on the other end of the coin, some of these other books toward the bottom, they're the reverse model. That's the maker-taker. So in these names, if you post liquidity, you have to pay to do that. And if you remove liquidity, then you get paid a rebate. So what you're going to see here is you're going to have your Boss X, you're going to have your BAT Y, you're going to have your Edge A. The most expensive of those ones, if you're adding liquidity, is Edge A. So therefore, there's a reason why you see this book only 1,000 shares it's the least posted on, because if someone's going to post, it's costing them the most amount of money. There is a disincentive on the US markets to add liquidity on Edge A. So smallest book, highest fee to add. Largest amount of size, highest rebate. It's not always that simple, but that's the basics of what you're going to be looking for on a stock like this in the US.
We'll jump back to a former episode of this segment that we did, and we'll talk about the setup here a little bit, Neil. I noticed that you have the NYSE highlighted there in black. Is that just a choice, or what's your reasoning behind that?
So a couple of reasons behind here, and we're going to get into this a little bit deeper. I have a chart. We have the second chart. We can show either one. It doesn't really make a difference. But because this is an Amex stock, I have NYSE highlighted. Ultimately, I just didn't move my axe. Usually I highlight NYSE because on that exchange, it's really important to see what the primary market used to be doing. It's not so important anymore. The prominence of floor brokers is not the same. So it's one of those things where it's legacy for me. The same way I have these trailing zeros that I have never gotten rid of, it's because when I started, I was used to seeing them, so I just leave them up there. It's the same thing with highlighting the New York book. I don't think ultimately it's more important than others. It used to be a huge factor trading on the primary gateway of the New York stock. So for me, it doesn't really matter too much. You can highlight any gateway that's important to you. One thing I've seen people do is if they want to get paid to remove liquidity, and they want to make the best rebate, they might highlight an edge A or highlight a bat Y, knowing that if I see that there and I remove from them, I'm going to get paid the most amount of money. Good way to control your fees.
Yeah, we were talking about that a little bit with Sean as well when we were going over the stock window or the level 2 window there. It's also a very quick visual reference, guys, to how relatively strong or relatively weak a stock is. As soon as you bring it up, if you see all of those freeze on the offer or freeze with lots of size on the bid, it's obviously a sign of relative strength or relative weakness. Let's keep going here. In Toronto, markets here also operate on the make-or-take model. Let's go over some of the most common ATSs here in Toronto and some of the fees for those.
So we're going to stick with a similar theme here, Brendan. I'm going to go to Bombardier just because it happens to be a stock with a nice deep book where you can see almost everybody there. The first thing to keep in mind, there's a difference in the primary gateway in Toronto as opposed to the New York, the NASDAQ, and the Amex. And that is, on the primary gateway, you have all of the different houses that you're able to display quotes on. So when I see these different banks like TD, and I see Questrade, and I see CIBC, that's all within the TSX book. So that's all one gateway. It's all the same rebate, it's all the same fee to remove liquidity. Now, getting away from there, you've got the largest ones. Typically, are going to be the ones that pay a rebate to post. That's going to be your Chi-X. That's actually your Equitas Lit. And interestingly enough, when it comes to paying to add liquidity, so the reverse model, you've got some ones where there's a lot of posting. You have Alpha Book, which is large. You have Equitas Neo. You've also got Omega, and then you've got CX2 as well. A lot of time what will happen is a specific gateway, Chi-X is an example here, as is Neo, will have both a maker and a taker. They'll have two separate gateways on the same exchange. Now, one thing you're going to note is larger size on some of these ones where you're paying to add liquidity. First to note, rebates are smaller on the Toronto Exchange, about half of what you would see. So relatively speaking, you're going to see a little bit less liquidity on a similarly priced stock and similar volume in Toronto as opposed to the New York Exchange. Another thing to keep in mind is sometimes if you're spread trading, here on Bombardier, 167 low of the day, 171 high, 4-cent range on a stock that had done over 3 million shares. Some people are so anxious to make the spread that they're willing to pay. They're willing to step in line, and I'm going to pay almost over $10 per share, over $1 per share, or 1,000 shares to be able to get that fill at 70, thinking they can get out at 69. Another visual way that I like to do here, and I wish we could show this to you, but there's no easy way to represent it, is think of this in two ways. If you're going to pay 1.5 on Alpha Book to sit in this book, then essentially what's happening here is when you're offering $1.70, to you, you're really offering $169.85. If someone wanted to remove liquidity off Alpha Book, they're actually offering $170.10. So think of this $1.70 range as a vast sea of different prices, and all of those different gateways represent those prices. It's a useful way to imagine that level, because when you interact with that price level at 170, you're paying a different fee depending on when you go. It's important to know what those fees are.
Awesome. Let's look, guys, at the make-or-take model, both in the U.S. and in Toronto. So a little bit of market structure there, some gateways and fees attached to that. Now that we have a little bit of an understanding of that, let's have a look at the basis point fee model. And we're lucky to have obviously the Bovespa that's trading down in Brazil, that's open during North American trading hours. Obviously, you're going to get the same fee structure over in most European markets as well. Also want to touch on Bovespa here because there's only one gateway, so it's not like North America where you have a whole bunch of choices where to send your order. There's only the main gateway. So let's have a look at some key features about the Bovespa, Neil.
Thanks a lot, Brendan. And so as we look at the Bovespa here, one thing you might hear Sean and I talk about this, you're going to see all the different brokerages and houses here. This is all one book. This is all the Bovespa gateway. If you're in TMS, you're going to see it as one consolidated quote at each price level. The first thing to keep in mind when you're talking about the basis points is you just have one fee for either transaction. You add liquidity, you remove liquidity. It doesn't matter. You're paying per share traded. It is a fixed number. What makes this good is it simplifies trading. You know exactly what your break-even point is going to be. If I take 1,000 shares long, I'm paying this fee, whether I add or whether I remove. One key thing here is some people will look at this and say, I can't make a rebate, I never want to post. Oh, the fees are too high when I remove. Remember, everybody is playing by the same rules. So when you have relatively expensive basis point fees, which Brazil tends to have, you can get bigger spreads that will open up. If there's no incentive for people to post, I'm posting 4,000 shares here at $23.99, whoever this might be, they're paying to do that. Everybody's paying to post, everyone's paying to remove. There's a cost to doing business, and there's no way to get around it. So what you might see is fewer people standing in the way of levels. You'll have a more thinly traded stock. Petrobras averages 50 million shares a day. It had done almost 40 million by lunchtime here. And it's a relatively cheap stock. If you convert this, it's under a $10 name. But look at the lack of liquidity. It's not that the liquidity is not there, the volume's going off. It's that people don't tip their hand because there's no incentive for them to post. What this can mean is there are quicker moves, better trend trading, because there's not as many people clogging up the order book with resting orders. So you can expect to see better trend trades, less size, and one thing to keep in mind here, if you're using key price levels for breakouts and stop orders, don't expect to see the same level of gigantic size around key dollar levels. I use this example because 24 has the same as 23.99. If I'm looking at the New York stock, I'm expecting to see bigger size here than the 99 just because it's a key area. There's no incentive to post a rebate, so people are not going to do that. You'll see that change in behavior. Adjust your trading accordingly.
Very, very different, obvious, differences in both market structures, both fee structures there, but very good to be knowledgeable on both, right? So let's now go down another level. We've kind of talked about the most common gateways both in Canada and New York, and also down in Brazil for Bovespa. Let's go down another level and talk about order types now. So whether you're more of a spread type trader, you like the smaller stocks with lots of liquidity and you're just looking to capture spread, or if you're more of a momentum type trader where you're aggressively removing liquidity and then waiting to get hit passively on the way up or down, depending on whether you're long or short. Let's have a look at some of the more common order types, Neil, that we can use for both being aggressive, removing liquidity, and also being passive, sitting, waiting for a fill.
Yeah, we're going to talk about two things here. When I talk about momentum, I'm going to throw up AMD, and then we're going to talk a bit about that rebate passivity that you're talking about, and we're going to have a clip for that, actually from yesterday, oddly enough. So starting here with momentum, I have an AMD chart up here. Ultimately, look, you can try to save fees all you want, and I can, if I'm trying to go short just because I see there's more size on the offer than the bid, I see it's at an even dollar area, and I want to be short this name, I can say to myself, well, look, I want to pay the lowest fee possible, so I want to find my edge A, my bat Y, my boss X that's going to pay me to remove. Well, what do I not see? I don't see bat Y until the next price level down. I don't see boss X at all. There's no one posting to those gateways allowing me to get the fill. So when you're momentum trading, getting into position matters more because I'm shorting 79 hoping to get out at 69. I don't care whether I save, 0.2 on 20 cents on 1,000 shares or $1 on 1,000 shares, who cares? I'm trying to make, 10-cent move on 1,000 shares, which is $100. So in that case, you want to prioritize the fill. So the first thing you can consider is where's the liquidity? I'm going to want to target the highest level of liquidity. Now, as a rule of thumb, I find it's usually instructive to start out with prioritizing the primary gateway. In this case, it's a NASDAQ stock, but you're seeing a lot of size on EdgeX, you're seeing size on BATS and ARCA. So in that case, you do want to have something which routes to all the available gateways. On a stock like this, you want access to everything on the bid, prioritizing the amount of size that you see relative to cost. That can be something you take in advantage. We have several routing keys. I don't want to jump too deep down that rabbit hole because that's going to be a topic of one of our other segments. For the second part of your question, Brendan, I want to roll a clip of me rebate trading yesterday, and we can talk a bit about it. I just got another position here, and I was just talking a second ago, of course, about the gateways to use on that thinly traded ARCI, and we got a position in this buyout CVRS. It's a stock that has a 428 cash deal, so it trades in a very, very tight range. You can look over here at the level at the chart and see that it's not going anywhere. 26 by 27. So when you're trying to spread trade this name, you can see the ridiculous amount of liquidity here. Everyone trying to catch that spread at 27. Everyone trying to get 25. In this situation, you get long 26, EdgeX, BATS, ARCA, they're paying you a rebate. There's a reason why those lines are long, but you slip in here and you look at Edge A, where you actually end up having to pay to add liquidity. You probably get filled first in that one, so you can jump the front of the line there. You're going to pay for that privilege, but you might get the fill faster. No one's actually catching those 27s very likely. Thanks a lot there. If we can get graphic 6 back up here, we did have that initial one, the first one, sorry, graphic 1 I believe it was, the very first one that we had up. One of the things that was important there is I'm talking about my strategy in general. It's just about I'm capturing that spread, and you're looking to get out any way you can. You know, similarly to when I said here, you're trying to get in at 79 on AMD, and I'm trying to make 10 cents. So what do I care about $1 here or there in fees? I want to make 100. The same thing sort of applies to the rebate trade. If I'm taking 10,000 shares trying to make the spread, ultimately, I don't care if I have to pay 15 bucks to get in or out. If I can get back in on the bid, you saw there was nothing on that bid and everybody on that offer. Any fill you catch off the offer is going to be gold, so you're willing to pay for it. That's not always going to be the case. Sometimes in that tight $1 spread or 1 cent spread, you are looking to make sure you capture that rebate of $2 per thousand shares, and you want to get it as many times as possible. So there are instances where you're going to jump back and forth as a rebate trader. As a momentum trader, you tend not to care as much. Brendan, what's next?
Yeah, obviously, you know, the same sort of principles are going to apply to the Canadian market. That was a, you know, obviously very in-depth look at how to deal with certain situations in the U.S. Same sort of situations, but let's have a look at some of the order types you can use for Canadian stocks.
Thanks a lot there, Brendan. You're looking at Toronto stock. It's going to be a very similar picture. The one thing you're going to note is a little bit different in Toronto. I had mentioned that the rebate's a little smaller. Instead of $2 per thousand, you get a $1 per thousand shares. You're going to see spreads open up on Toronto stocks more than you're going to see them in the U.S. And that's why we're going to talk about midpoints as its own section as well. But you have to think about those order types because it's going to be difficult to get filled on the offer when you see this open up. That's why you'll see sometimes what we will do is we'll make this new level here. If I wanted to get short on this stock, I might make a level at 14, make a level at 13. And if I'm doing that, I'm probably going to want to add liquidity on something that's paying me. I'm making a new price. I'm being relatively aggressive. I think it makes sense for me to catch a rebate doing it. Whereas if I was going to be sitting on a level hoping to get a fill at 15 when it's 12 by 15, then I'm going to use a free. And look at what's here. You see 1,000 shares on Alpha, 3,000 shares on CX2, 100 shares on Omega, and only 100 on KAIX. Everyone's thinking along the same lines. Everyone trying to get the top of that spread, the 15, is willing to pay to do so. So when you're trading these names, if you're going to cut the spread or use midpoints, I'd be trying to get rebates in those situations. That's probably the main difference between Toronto and the U.S. that I can look at. Everything else sort of follows the same rules, Brendan.
Yep, fantastic information, guys. We'll wrap it up at that. Obviously, a subject, as we mentioned, that we can you know, go very, very in depth with and touch on all kinds of subjects. Neil mentioned you know, routing, obviously very highly correlated with the gateways. So we're going to do another segment, a separate segment just on routing, and touch on you know, some other order types that we can use in different situations, like halts. When you're you know, stuck in a halt, what do you do? What order type do you use to get out, or maybe even want to get into a stock when it's halted? So great segment there, lots of great information. Hope that helped for everybody who's watching. Again, guys, if you want to have you know, anything covered in these segments, please let us know. We'll put together an educational segment on basically any topic. We're an open book. Feed us some topics that you guys are looking for. Let's get this thing wrapped up for the day. We'll send it back over to Sean and Neil.